Hello again, everyone. I came across one of those pieces that was so interesting to me that when I started highlighting it, I don't know if you can see this, I almost highlighted the entire thing. It's a bad habit of mine. I get going crazy with this thing, but it was so interesting to me, and so I was going to try to share some of the highlights of this piece because I think it's interesting. It gives us perhaps some ammunition for our minds going forward. So this is a piece put out by First Trust. Their chief economist is Brian Wesbury. He's attained some measure of accomplishment as an economist. It offers an interesting perspective on the market downturn that went with the financial crisis in 2008 and early 2009. On March 9th of 2009, the House Financial Services Committee held a meeting, and the topic of discussion that day was mark-to-market accounting. Now, stepping away from my script for a moment, I probably have a good paragraph worth of material that I'm just going to ask you to hang with me because I think the end of this will clear up what's going to sound a little bit technical for a minute. Mark-to-market accounting forced banks and other financial institutions that owned assets that were priced to illiquid market prices on a daily basis, and the article asserts that this was a recipe for disaster. As long as assets were priced to illiquid market prices, meaning markets that weren't trading regularly, the banking system would continue to contract because the lower prices would lead to them having to declare less capital on their balance sheets, would lead to more selling and less liquidity, which would lead to lower prices, and it was a vicious and unstoppable downward spiral. In addition to that, private investment money dried up as they were panicked by this sort of activity. There was plenty of government action taken during this time that you may recall. One of them was the TARP bailout, and another was referred to as quantitative easing, also known as QE. It's been redone a couple of times since. Per Brian Wesbury, these two programs printed $1.3 trillion worth of money in the fall of 2008, and yet despite those programs, stock prices continued to fall sharply all the way toward the spring of 2009. The article asserts that it was the accounting rule itself that dried up liquidity during the winter of 2008 and 2009, and as a result, it kept investors away because they kept threatening this vicious downward spiral in the financial system that I just referred to. Now, I told you all of that just so I could get to this. Milton Friedman explained in his book, The Great Contraction, how mark-to-market rules, not bad loans, caused bank failures in the early 1930s. You might recall that was the period known as the Great Depression. It was in 1937 that the FDR administration eliminated this mark-to-market accounting rule. And it's probably not a coincidence that between the late 30s and 2007, the economy avoided panics and depressions. You did not hear me say that it avoided recessions. There's been plenty of those, but it avoided panics and depressions. And Wesbury and his associates don't believe this is a coincidence. It's further interesting that these accounting rules were changed in November of 2007, which was just after the market had topped out at new market highs in October of that year. Wesbury believes that if the M2M rules had never been instituted or had been corrected in early 2008, the financial crisis would have been much less severe. Instead, the Treasury and the Fed, along with politicians who supported TARP and QE, have argued that the economy was saved by government action. Wesbury concludes that this is a dangerous argument. Conventional wisdom believes that without government intervention, the free market economy is nothing more than a casino, and this is just not true. The history of the past few years provides strong evidence toward this. We can all thank the House Financial Services Committee, led by Barney Frank, of all people, for the work that they did to change this rule that caused so much trouble. It's also not an accident that it was March 9th of 2009, the date of that meeting, that market downturn bottomed out and started up, and it has never looked back since. Good information. Until next time, thanks for tuning in.